How would you like to turn a $10,000 profit deal into a deal that grosses $100,000? I'm gonna walk you through a full case study of a deal that we actually bought that's gonna gross us around $100,000 using what I call the slow flip strategy. I'm gonna walk you through before and after pictures and all the financials, so be sure to stay through this entire video. As always, click the like button if you like this video, comment below, leave your questions, leave your comments, and subscribe. Let's get going to the case study. So this is a deal that we bought from a local wholesaler. It was a vacant home, and it is the biggest quarter house that I've ever walked. And I've walked a lot of houses, having flipped 200 or so houses over the years. And this was the worst one that I've personally walked. The good thing about it is walking the house, even though it was just trashed completely, the structure and the bones of it appeared very, very good and in good shape. So it seemed like mainly a cosmetic repair. There were a couple of the systems that we knew possibly could need replaced, but we ended up buying this house for $103,876. We estimated repairs to be $45,000, and we estimated the ARV, or after repair value, basically what it's worth once we do the full remodel, to be about $190,000, and rents to be $1,700. And we ended up closing on this property December 23rd of 2020 with the intention of renting it out. After we did the full remodel, a few surprises ended up coming up, as they always do. We actually ended up spending $55,464 to make this house just pretty much brand new at this point. The HVAC system was older, but it appeared in good shape. We did end up still having to replace that and duct work. Electrical panel, which appeared in good shape, but we ended up having to replace that. The surprises were there was a lot more sheetrock work than we had planned on. Once we removed all the debris, it looked like there had been some water penetration, so we ended up cutting on a lot more sheetrock than planned. But the big surprise was new plumbing. The sub-slab plumbing was in good shape, but the plumbing in the walls in the attic was not in good shape, and that was something that we just weren't able to see. Ended up having to replace that. But when we were finished, this house looked absolutely beautiful, especially compared to how just junked out it was before. It ended up taking us 6 weeks to complete this rehab, and we leased it out in 2 weeks for $1,750, a little bit more than what we anticipated, $1,700 when we actually bought the property. All right, we bought it, we rehabbed it, we got it rented. Now let's look at the numbers. Before we look into the actual numbers that we're projecting, holding it as a rental using the slow flip strategy, I'm gonna show you what would happen if we were to actually have flipped the property. Let's look at those numbers first. This is an analytics software called ROI Muse. It breaks down pretty much any type of financial situation or exit strategy that you would use with real estate investing, from the BRRRR strategy to going all in with cash, wholesaling, flipping, and there's even commercial and multifamily analysis that you can use. What I'm using here is the flip parameter, and what we're gonna do is we're gonna break this down and compare if we were to flip it versus what we're actually doing is holding it as a rental. And I'll put a link to ROI Muse in the notes. It's investor owned. He's a real estate agent, and very successful real estate agent and investor. And I really like this program. I wish it came out years ago whenever I was playing around with Excel formulas. So we anticipated this property was worth $190,000 when we originally bought it. We bought it for $103,876. Our rehab estimate was actually 10 grand over. So this is actuals rehab, it's not our estimate. So we ended up spending $55,000 on the rehab. So our all-in cost was $159,000. Rents, it's a little irrelevant for a flip, but $1,700 was the original estimate. It was going to take us 2 months to lease it. Now that is from the purchase price, or from the actual closing of the purchase all the way until leased, which that's what we did. It took us 6 weeks to finish the rehab, 2 more weeks to actually get it leased. Property taxes, insurance, HOA costs are really low in the subdivision. Loan to value. So if you were using a hard money company, you wouldn't most likely be able to get a loan to value of this amount, but I have a little bit more flexibility with my lender. But let's just say loan to value that you got 75%, more common, 10%, 1 point. If you're using private lenders, that's very common. You may pay 2 points. If you're using a hard money company, maybe like 12, 13, 14% with 2 or 3 points. 10 and 1, that's most likely what I would have paid if I would have gone in as a flip. This is actual fees for closing. This actually includes the lender fees, not origination, but loan documents. We didn't do a survey or appraisal, so nothing there. Months to sell, so 4 months. What I included here is, say it takes 2 months to actually get a contract, and then you've got a month or maybe 45 days of closing the buyer's loan, put you around about 4 months as conservative. In this hot market, that is being very conservative, because in all likelihood, it would have been 2 months max. The market's just too hot. Ultimately, for sales costs, 4%, that's 3% to the other agent, about 1% for closing cost, because I am an agent, don't really have cost on my end. But if you had to pay a realtor on your end, then this is going to be a little bit higher. Utilities, $200 a month, which that's probably a little conservative there too. Gross profit. This is ultimately what we would have gotten. 10 grand for all that work, all that risk, and the risk is the big part, $10,000. Now, if we wouldn't had the overage on repairs, then it would have been 20 grand, which is still really, really risky for a flip. There's just not enough margin for a house that's only worth 200,000. Because if we weren't going to get our price, and we were a little bit off on the repair estimate, so if both of those things happen, then it ends up being a negative deal, or at best a break-even deal. That's not a good situation. But in any case, if we wanted to wholesale this property, we would have had to buy it much cheaper, which in this case, that's what the wholesaler did, and they made a nice return on their money or on the contract that they got it at. But in this situation, if you wanted to wholesale it and make 5 grand, assuming all the other details, then you would have had to locked it up at $98,000 or less. Now, this little 10 grand or almost 11 grand, we're going to compare that with what is actual, like what we're actually, let's see, what wants me to save. What we're going to do using the slow flip strategy. So the slow flip strategy is like a variation of the BRRRR strategy. I just tell folks, hey, instead of flipping in 6 months, flip over a 5-year period. That way you can take advantage of appreciation in the market, depreciation for taxes, cash flow through rent, equity pay down, which is not much over a 5-year period, depending on your loan type. And you let time do its thing and ends up giving you a much bigger margin. So that's what we're gonna look at here. So same numbers, 190,000, purchase price, all in 159,000. Rents, we actually rented it at $1,750, so we got a little bit more than anticipated. It's always nice. Property taxes, insurance is lower here because it's a rental policy versus a builder's risk. And I estimated $1,400 a year for builder's risk. On the other, in the flip scenario, it could have been a little bit more. But here, this is actual $1,068, $60 a month for HOA. Maintenance and repair escrow. So I always estimate 10%, and I wrap CapEx all into that because we put so much work into the front end of the property. Really, if I wanted to decrease this and add a CapEx, I could. In this case, I didn't. I'm just kind of wrapping it all up together. Now, if we went in and we didn't do much work and we knew the roof was older, we're going to want to add some extra for CapEx. But in case, you absolutely do have to reserve for repairs and maintenance. It's always going to happen. Vacancy, you're always going to have them. In CapEx, I just happen to be lumping CapEx right here. There is no management fee because we self-manage, but if you do have a management fee, you can put that either the dollar amount there. There's a lot of flat fee management companies that are really good that will manage for 80, 100, 120 a door, any of their expenses here. So hold period. We're going to hold this thing for 5 years, anticipating 2% rent growth. Rent's been growing a lot faster than that lately, but that's what we're going to estimate here. 2% expense growth. Home appreciation, 3%. Historically, that's common for the Houston area, but there's a lot of things going in my favor for this type of price point, but I'll get into that in a minute. Disposition cost, again, 4% because I'm an agent, don't have commissions on the other end, which I'm with eXp Realty, so I do pay myself a commission on the other end, but it basically ends up being a wash. And I do that because of the stock benefits and everything else with eXp. Loan to value. This is the actual loan I did get, $152,000. Used a private lender, 6%. one point. They're very happy. They get cash flow. I got a good rate, and it's a private loan. Closing costs, that's actual. So all in, I have about 12 grand, almost 13 grand in investment in this deal by the time you add up all the expenses and everything, because of what the loan is and what I actually spent. But watch what happens here. Let's go. I'm gonna scroll all the way down to the actual finance or year breakdown. So year 0, this is my initial investment. Year 1 after cash flow, that's not bad. What is that, like $260 a month? Year 2 grows slightly, and in retrospect, depending on the market, depending on your sub-market, but I know in this specific market, it'll be fairly static because there's always going to be some repairs that end up knocking it down a couple pegs, and then rent increase will bring it back up. Taxes are going to go up too. So don't ever anticipate single family rentals. Well, know your market, but in Houston, I don't necessarily anticipate over time net cash flow to increase much from year 1. It's pretty much going to be the same. And if it does, that just means the property value went up way up, and maybe I want to recapture the equity. But anyways, in year 5, $74,000 in gross. This is a sell point. So in year 5, we're anticipating that I could sell this property based on 3% rent growth year over year at $220,000. But I mentioned I want to go back and revisit that. But before I do that, look at that IRR. Hard to beat that. Let's look at some of these other, let's see, I think I'll scroll up here. So 40% ROI, that's year 1, 26% cash on cash, year 1, just amazing IRR. So the numbers are looking really good, but this $190,000, that's the value that we thought when we bought it. When we actually finished the rehab, I did another review of the comps. The market had already increased, so it was already, the market had actually already brought it up to about 205. Today, not even 9 months later, the market in that subdivision has this property at about 215. That's not going to continue forever. I absolutely know that. But when you take that into account and you assume it's only going to do that for this year and it will not do that for the next 4 years, it averages out to about a 5% rent growth. Now let's go down. Now we're looking at a gross profit of $95,000 at the end of this 5-year period. So let's flip back here. Let me save it. If we flip it, $10,700, assuming we actually sell it for $190, they don't come back and say, hey, we don't want all these other things repaired too. If we hold it as a rental, $95,000. Which one would you rather have? But it's not just $95,000 because I'm actually going to get depreciation on my taxes. Yes, there is depreciation recapture on your taxes, but there's time value of money. And we'll be able to accelerate a lot of that depreciation on the first couple of years and take that money and take that savings off other income and redeploy it back into my business. It's going to give me a lot more bang for my buck. And what I'll do is I'll take this and then I'll go roll it into 2 or 3 other rental properties. That's the slow flip strategy. So my advice to real estate investors out there that are wholesaling properties or flipping properties is find a way to where you can take 1, 2, or 3 of these properties a year and put it into your rental portfolio using the slow flip strategy. If you could have 1 property a year in your rental portfolio that's going to gross you over a 5-year period of $100,000, then just get 1 a year. And then at the end of year 5, like if you just wanted to cash it in and do that every single year, continuously buy 1 a year, then at year 5, you can start selling 1. Then you've got an extra $100,000 gross constantly coming in. Or if you want to accelerate a portfolio, which is what I personally recommend, using the slow flip strategy, take that $100,000 and don't go blow it on a new car or lavish vacation, but use it to buy 2 other rentals. So now instead of just 1 property, you turn 1 property into 2 or maybe 3. And you do that over a 10, 15, 20-year time period. That's how you build massive, massive wealth and passive income. You could 1031 exchange if you really want to accelerate it. Maybe even 1031 exchange into a multifamily property and leverage up, level up your business. And there's just so many ways to use this strategy to further your wealth creation and your passive income. So overall, buy properties, but hold more than you sell. If you got anything out of this video, please click the like button, comment below, leave your questions, subscribe, and thanks for watching.